Right. Uh, Bank borrowings. So whether does a bank borrowing a cash equivalent? Borrowings are generally considered to be financing activities. So, however, it is cash equivalent when it is repayable on demand. It's form an integral part of an entity's cash management, and a characteristic of such banking arrangement is that the bank balance often fluctuates from being positive to overdraft, right? So when they manage cash, they use heavy the entity should heavily use their bank overdraft facilities. It means the bank balance some days will with positive values, sometimes will have minus, which means overdraft states. So cash flows and cash management. So what's the difference? Cash flow is the movement of cash. So how the money is come from and how will the money will go out. That's cash flows. So this cash flows may be in three forms: operating activities, investment activities, and finance activities. Cash management is simply managing cash. So how much amount of money will have to keep in hand. So when the excess money will have to invest, when money in during the period of money deficit. So which asset have to convert into cash, which investments should convert into cash back. So that's the cash management, that kind of decisions. It is simply uh, movements between cash equivalent, and the movement between cash and operating, investing, and financing activities form a part of cash flow of entity, how money moves. So movement between items. So movement between items mean what? Investment to cash, cash to investment, cash in hand and cash in bank, so deposit and withdrawal, right? So movement between items that constitute cash or cash equivalents, a part of cash management of an entity. So cash management thus include the investment of excess cash and in cash equivalents, right? So when the entity face encounter cash deficits, they will convert investment to cash, and if the entity encounter with excess money, they will invest into the cash equivalent. So to understand whether a particular asset, a particular item can be considered as cash or cash equivalent, so we have a few examples. So here illustration state whether the following items in cash equivalent, whether the following item is cash equivalent or not. So give justification in the background of LK 7. So you know that there should be four criteria to consider an item as cash or cash equivalent. So based on that knowledge, you can decide whether it's whether the item considered to be cash equivalent or not. The first instance, an entity has a cash on 2 month fixed deposits. Think about here, 2 months, it's less than 3 months, and it's fixed rate of interest. It means less chance to fluctuate to the interest rate changes. So therefore, it will not impact on the risk and value, right? A fixed deposit with a commercial bank. If the entity withdraws the capital before it matures, it foregoes an insignificant portion of interest anyhow. So it matures in 2 months, within the 2 months, if the entity wanted to withdraw that money, so it will foregone. They have to lose their interest, not principal amount. On maturity, the entity expect to use the proceeds to settle within the trade creditors. So there should be a 4 criteria, right? Here the answer, the fixed deposit is a cash equivalent. Why? What's the justification? It's a short term, so less than 3 months, so 2 months from inception. Highly liquid, so can be withdrawn at any time. We don't want to wait to up to 2 months. So readily convertible into a known amount of cash. So they know. So if they deposit 10,000, definitely they can withdraw at least 10,000. So amount of cash, capital plus specified acquired interest, and subject to insignificant risk of changes in value because it's a fixed rate of interest instrument. So with 2 month maturity is unlikely, the less chances to change significantly in the value in response to changes in the market interest rates, and the penalty for for early redemption is insignificant. It is also intended to be used to meet short-term cash commitments. So illustration 2, an entity acquires 3 years fixed rate, right? So it's 3 years fixed rate, a government bond in an active market. Very important, active market. Active market means a particular bond can be tradable at any time, can sell at any time in the market, active market, right? And 2 months before the bond mature date, so they purchase the stock before 2 months, and it matures, right? The 2 months before the bond maturity, right? So it's mean the investment period is 2 months, even though it's a 3 years instrument. It was purchased in the stock market, in the capital market, before 2 months of maturity date. On maturity, the entity expect to use proceed to settle with trade creditors. Trade creditors. It means uh, the entity keeps excess money and counter excess money. So they wanted to invest that money in short-term investment. That is, the entity should wait for about 2 months maximum to convert that bond into cash, and also the money proceeds will be used to settle the creditors. That may be in the 2 months. So what's the answer here? So this investment is a cash equivalent. It's a short term. It was acquired. It was purchased 2 months before its maturity date. It's a highly liquid. It can be traded in an active market and is readily convertible into a known amount of cash. I mean, capital plus specified acquired interest on maturity in 2 months or before due date at the market price, because the instrument has fixed contractual cash flows that are close to maturity. The variability in the fair value of the instrument is likely to be insignificant and to be subject to an insignificant risk of change in value. A fixed interest rate instrument with a 2 month maturity is unlikely, so most probably less likely to change significantly in value in response to changes in market interest rates, and penalty for early redemption is usually insignificant. It's also intended to be used to meet short-term cash commitments, that is, trade creditors. Then we'll see the third instance, an entity's check accounts, current account with commercial banks fluctuate between having positive balance and being in overdraft in accordance with their entity's cash flow receipts, cash receipts, and payment cycle. So the account balance some days shows positive balance, in some days gives negative balance. So the overdraft is repayable on demand. So whenever the bank manager calls to settle the overdraft, the entity should do so. So it's obvious that it's a cash equivalence. The bank overdraft is a cash equivalent. It is repayable on demand and a form an integral part of entity's cash management. And illustration 4, an entity has a pre-approved credit line, the overdraft. It's mean uh, the bank, the entity has a demand deposits, mean current account, and the bank has made an arrangement of overdraft facility up to 10,000 US dollar. But the case is the entity never used this credit facility, the overdraft facility provided by the bank, by the entity. Here in the situation, the entity has a pre-approved credit limit overdraft with the bank of up to 10,000 US dollar. Because the entity has never used the overdraft, the account balance is nil. So because it's not a cash equivalent, because the bank overdraft facility has never been used by the entity, so it does not appear to form an integral part of entity's cash management even though it is available. So it is neither cash or cash equivalent, cannot be considered. And illustration 5, an entity acquires 3-year fixed deposit, 3-year fixed rate government bond in active market 2 months before the bond's maturity date. The entity holds the instrument to speculate on changes in market interest rate. So the purpose is not the cash management, rather for the it's the purpose of this investment is to make money, to make profit. So it's not a cash or cash equivalent. So because the investment held for speculative purpose rather than to meet short-term cash commitments, it's neither cash or no cash nor or cash equivalent. And 6, an entity has cash flow on 5 years fixed rate fixed deposit with a commercial bank. At the reporting date, the fixed rate deposit is 2 months from maturity. If the entity withdraws the capital before maturity, it forgoes all interest. On maturity, the entity expects to use proceed to settle with state creditors. So here what's the issue? Cash equivalent or not? So an entity has cash flow, cash on 5 years fixed interest rate commercial. So they have deposited 5 years ago. 5 years ago, all other criteria are met anyhow. It is not a short-term investment, so therefore it cannot be considered as a cash or cash equivalent. The investment is neither cash or cash equivalent because it is nearly 5 years since the entity made the deposits. So that is, it's not a short-term deposit, it's not a short-term investment. So note that it is irrelevant that at the reporting date the deposit is only 2 months from the maturity. So it remains 2 months. In the point of view of balance sheet, it has only 2 months. It's may considered as a current assets, but actually, when they make investments, it's really basically it's a long-term investment. And classification of cash flows. So it's not as new things to you all. So we can categorize the cash flows into operating here. So operating, right? Classification of cash flows. So presentation of statement of cash flows consists of three parts. First one is operating activities, investing activities, and financing activities. So operating activities we have discussed, right? We have discussed in the beginning part of the session, and we have studied earlier. So we don't want to spend more time on here. So operating activities are the principal revenue producing activities of the entity and other activities that are not investing or financing activities, right? So these operating activities will not consider any uh, investing and financing activities. So the amount of cash flows arising from operating activities is a key indicator of the extent to which the operations of the entity have generated sufficient cash flows. So why do they why the operating cash flow is very important? So to repay loan, to maintain the operation capability of entity, pay dividend to investors, make new investment without recourse to external source of financing. So information about specific components. So specific component here mentioned that there are different units, components that make profit. So different branches or different product items. So information about a specific component of historical operating cash flows is useful. So in conjunction with other information in forecasting future cash flows. So here, for example, an entity have three components. One component produce X, second component produce Y, third component produce Z, product Z. So to make decisions, so which component is make more profit. So to analyze this kind of things, so the cash flow operating statement is very important. So cash flow from operating activities are primarily derived from principal revenue producing activities of the entity. So therefore, they generally result from the transactions and other events that enter into the determination of profit or loss. So it's a major major day-to-day operation of the business. So it decides it decides the profit or loss of performance of the entity. So there are some examples for operating activities here: case receipt from sales, case payment for suppliers, royalties, and case payment to suppliers, and case payment on of employees, wages, salaries, and case receipt and payment of insurance entity for the premium. In for insurance companies, the payment of interest premium, so in payment of interest client insurance client, and payment of uh, insurance premiums are the major operations. And the case payment or refund of income taxes, and case receipt and payment from contract held for dealing for trading purposes. Right, some transactions such as a sale of item of plant property, plant machineries will not considered as uh, operation of the business operating activities. Anyhow, such asset, the manufacturing, the making of such property, plant assets, or the acquiring of such assets, that is the purpose of that asset is to give the asset for the rental purpose to other entities. So accordingly, so their main business is provide the assets PPE to make money. So therefore it can be considered as operating activities. So the cash received from the rent and subsequent sale of such assets are also cash flows from operating activities. So this time it cannot be considered as investment activities. An entity may hold securities and loan for dealing for trading purposes, in which case they are similar to inventory acquired specifically for resale. So some entities uh, invest purchase securities, bonds, shares for the purpose of resale. So that is the main business. In that circumstances, so that case movements coming under the operating activities. Similarly, case advances and loans made by finance institutions. So when you consider the bank, so what's the major business? Providing loan and accepting deposits. So this is the case movement. So that is the main business. So it's coming under the operating activities. So investing activities are the acquisition and disposal of long-term assets. Long-term assets and other investment not included in cash equivalents. So not cash equivalents mean what? The short term. The separate disclosure of cash flows arising from investing activities is important because the cash flows represent the extent to which expenditure have been made for resource intended to generate future income and cash flows. So there are examples here: the cash payment for purchase of PPE and cash receipt from the sale of PPE, and case payment to acquire equity shares or debt instrument of other entities, and joint ventures, so purchase of subsidiaries or joint ventures. So payment, right, and case receipt, the sale of equities and debt instruments of other entities, and case advances done by uh, a loan provided by non-finance companies, not bank, or not finance institutions, and case receipt from the repayment of loans and advances of non-bank finance companies, and case payment for future contract derivatives, options, swaps, and case receipts in similar way for the future contract, forward contract, option contract, swaps, and when contract is then accounted for a hedge of identifiable position in the case. So finance activities very simple. Financing activities are the activities that result in changes in size. So when more equity capital comes, the company size will go up, and the composition of contributed equity and borrowing is a structure mix, capital structure. So what's the portion of equity, the portion of borrowings. The separate disclosure of cash flows arising from financing activities is important because it is useful in predicting claims on future cash flows by providers of capital to the equity. So there is an example: case proceeds from issue of shares when the company issues equity shares, and cash will inflow. That's coming under the finance activities. Cash payment to owners to acquire or redeem. So redemption of shares, redemption of bond, long-term bond. Cash proceed from the debentures, loans, notes, cash repayment of amounts borrowed. So the companies now settle the borrowed money, the bank, and the cash payment by lease for reduction of outstanding. Right. So that's all about the presentation. So any questions we can